All right, Sandeep Tandon joins us now, represents Quant Mutual Funds, to talk about what he thinks where markets are headed and what is the best way right now to position your portfolio ahead of the US presidential election. Sandeep, fantastic to have you back. Thank you for joining us. We were just trying to understand the scenario which could be at play because of the US presidential election. What is your understanding? Are we in for some period of volatility, give and take both, assuming that this time it's not going to be it's not an easy election to call?
That's correct. So the way we look at from a very near-term perspective, I believe the geopolitical volatility can remain elevated for maybe a month's time or so. So our approach has to be, we have been very cautious in the current environment and focus a lot on the domestic companies rather than the global company, because we believe that we are definitely there in the some sort of risk of environment currently. And with that background, I expect the developed market has the potential to correct and consolidate from these levels. And I don't rule out even sharp crackdown also can happen in next 15-20 trading sessions point of view. But so very cautious approach we want to take from the market, given the background of high walls.
You're a mutual fund, and mutual funds have a mandate to remain fully invested. How are you approaching your cautious view with your portfolio composition? If you are cautious, are you sitting on cash? Are you moving towards defensives? Because if you are bullish on steel and cement, that means you're bullish on the economy. So if you're cautious, why are you bullish on these sectors?
So, as you aware of that, we believe in a very dynamic style of investing. So we believe that when we track sector allocation very closely or sector rotations very closely, okay, and we have seen that now easy phase of chemical or pharma, which we are very bullish, though we remain still very bullish from the very medium term or near term perspective. I think this sector has potential to consolidate, and then we believe the current level, I think domestic sector like cement, steels are performing very well. So, and these are the stocks which are completely under-owned by most of the funds. So we believe these are the sectors. So we have increased our exposure towards cements, metals, IT also in the early part of September. So though we remain cautious, we are trying to identify the stocks or the sector where my downside is protected and upside is pretty open.
The sector, Sandeep, that you alluded to was pharmaceuticals, and that is a sector that you have been fairly bullish on for quite some time, talking about a strong structural bull run. What do you make of the run-up that we've seen so far, and what do you think the opportunities look like now for Indian pharma going forward?
So when we talked about this is the opportunity for 3 years perspective, and from September 2019, the possibility of the 2020-21 sort of thing, we can see these levels. So maybe pharma has potential to outperform bank. That was the theme we played out, okay? And we have seen bank has corrected a lot. So now we have to take a conscious call from the current level, whether banks has potential to outperform pharma or banks has potential to outperform other sectors, okay? So from a longer term perspective, pharma remains as a core, but from a very near term perspective or medium term, if I have to say from a medium term perspective, I believe the metal and cement has potential to outperform banking also from the current levels. So we have increased our exposure towards these names. Our incremental money which we have received, we have deployed towards domestic economy stocks instead of our old-time favorite chemicals and pharma.
What about the move in the telecom space that we see in a very tight race being fought? Do you believe that consolidation is the name of the game, or is there very select opportunity here?
So I think definitely we have seen good up move in the telecom sector, and maybe last 1 month has been painful for few names. Okay, I think it's more of a technical factor given the MSA rebalancing issue. The stock has become slightly overrun. So, but from a longer term perspective, we remain very, very positive from the telecom sector point of view. So we remain positive, but I think I think market will take some more time to consolidate before it shows a big up move from the current levels. So we remain constructive on these levels.
Sure. Sandeep, just to probe a little bit on the point that you just made, would it be a concentrated move tilted in favor of Reliance, or will the incumbents as well participate in the move?
Yeah, I think the way I look at from the Reliance point of view, or even from the some of the stock which has outperformed very significantly, particularly in last 6 months or so, I believe from the behavior point of view or behavior finance point of view, which we track very closely, we believe this is the time for you have to look for stocks in the neglected territory rather than stocks which are trading in the most admired category. So most admired category stock has a potential to correct and consolidate, and we tend to identify stocks in the or sectors in the neglected territory which positive trigger points and near-term visibility. I think those are the stocks the sector has potential to outperform market from a medium-term perspective.
Sure, got your point. Sandeep, correct me if I'm wrong here, but one of the themes that you're betting on is also select OMCs. Why so?
So purely from the valuation point of view, some of the PSUs are very, very attractive. Instead of buying as a basket approach of the PSU, which a lot of people do, we believe the utilities and OMCs are better play from the valuation perspective. And I said these are the stocks which are now trading in the most neglected territory. So we like some of these names from the current levels.
Agrochemicals as well, Sandeep, is the other theme that you're liking. What is the rationale based on? And within agrochemicals, because it's much a derivative like a specialty chemicals, wherein each and every company has a very different theme and a very different niche. So what within agrochemicals is of interest to you right now?
So our call has been, and this is a very longer term call, we believe from a decade perspective, agriculture prices will go to the roof. Okay, with this background, we believe inflation is also coming back with a bang. Okay, and if this is the theme which is going to play out, then I think agrochemical sector or agrochemical stocks in general will be beneficiary a lot, and the sector which have inputs of agri stocks, okay, or agri as a portfolio will be impacted in a big way. So we like to skew our portfolio towards inputs of agri and rather than agri chemical like seed company, fertilizer company, specialty chemicals company. So those are the names which I like to participate. Okay, anything linked with agri related things. Okay, where consumer or agri products, some of the MNC names, some of the FMCG companies, we believe from a longer term perspective, they will be a big impact, and which we have seen some sort of reflection in this quarter numbers of two large companies.
Top 3 holdings right now, Sandeep. Sandeep, what are your top 3 holdings or top 5 holdings? I'm just trying to understand the flavor of your portfolio.
So see, the way we construct our portfolio, we also try to give some amount of weightage for a special situation in our portfolio. So instead of holding 10-20% cash, which people like sometime in uncertain environment, we hold cash through special situations. So like small example, since a well-known trade in the market, like Majesco is our top holding. Okay, why it is a top holding? I consider is equivalent to cash because it was a special situation. Right from 600 levels to 800 levels, we were buyer in that stock, and we believe that 1020 is the fair price which management is offering as a special dividend, and as a mutual fund, we don't have to pay a tax. So we tend to keep like 15%, 20% sort of our portfolio in a special situation. And that's the reason sometimes you find some odd names in our top holdings. It is basically they represent cash up to large extent. And within the top holdings, which we like, we still like though. So some of the pharmaceutical stocks are part of our top holding, agrochemical stocks are part of top holding, and so is the case with telecom also. Okay, but these are the stocks which are from a longer term perspective. But remaining other sectors, which I said, like we were bearish or either underweight on the IT till August end. But in the first week of September, we built massive positions in the technology stock, which we have pruned down partially, and we have added cement and metals in lieu of that. So we manage in a very, very dynamic environment. As I say, as our data point changes and we have to adjust our portfolio, so we adjust in a dynamic manner.
Why are you taking a bet on cement and steel? Why not banks? Because if cement and steel will do well, banks will have to do well. That Because for these companies to do well, lending has to pick up, credit has to pick up, economic activity has to pick up. Banks are already bombed out. Why not, walk down the easy path rather than trying to expose your portfolio to the vagaries of global volatility in metal and local volatility in cement prices?
So our call is much larger macro call, which we are looking at. I said that we believe from next 10-year perspective, global market is going to be very challenging. We believe highest level of bankruptcy will be filed from 2018 till 2028. Inflation will go to the roof. Okay, with that background, we are clearly looking at that some sort of recession is coming globally, and hence we like to avoid leverage economy stock with this background. But as a domestic economy, do we get some direct opportunity, direct play? So then we have. So this could be one of the reasons why we are looking at commodities. And commodities, we also are bullish from 2021 perspective. And we keep in mind when inflation comes back, in the commodity prices anyway moves up. So we are looking for direct beneficiary of commodity stocks rather playing indirect benefit of that. So it's a theme which we believe that will play out, and we have been talking about this theme in our book being relevant from 2019, saying that 2020 we see a massive up move coming in the agriculture prices globally, and which we have seen agri prices have moved up, and we can believe that by 2021 it will access towards both non-ferrous and ferrous metals also globally. With that background, we like to skew our portfolio. So as I explained, we are very macro-centric firm. So call is very large macro perspective that commodities bull run is coming back. Agri will be a massive bull run, and within agri, we can say some amount of impact will be there in other commodities also. And given the background of weak dollar index, we have been forecasting right from 103, 104 levels that dollar index is heading towards $65 levels in 3 years per time perspective. So that is the classic background which we are looking at for increasing our exposure towards commodity stocks, and then like to play stocks directly rather than playing through banks.
Does the ECG criteria fund which you're planning to launch, how does this apply in steel and cement? Because these are sectors which in a sense do create carbon footprint. So the E, which is environment of the ECG fund, will steel and cement qualify there?
So it's a very interesting point of view. First, let me just spend a minute on ECG first itself. Why the key rationale for launching is that it's not just one of the schemes which we are trying to launch. We believe that globally also, if you look at from the developed market point of view, most of the global indices, particularly US and Europe, are more skewed towards ECG compliant companies. In fact, the ECG outperformance in US market has stopped completely. And if I look at for last 9-10 years data, then emerging market ESG indices have given outperformance like 50%. MSCI India ESG index has given outperformance of 60% in the last 9 years, and so is the case with the recently created NFT ESG index of the 100 stock that also has outperformed by 40% in the last 9 years. Okay, so we believe that ESG could be a big opportunity for the emerging market and within that India. But why it is very vital for us as a house, as a mutual fund perspective, because we believe that over a period of 10 years, 15 years perspective, if I have to look at, most of the schemes in India or globally fund manager, it will known as ESG compliant schemes. Okay, it's not necessarily ESG. Right now we are launching ESG, but over a period of time, I believe that it will become ESG compliant, because very, very important, because in the last many years, we have been only focusing on the financial data. So non-financial data also plays a very vital role, okay? And this is one of the reasons why we are also very excited that we believe via ESG route, we are able to quantify the quality, okay? So we are adding Q square, that quantifying quality, to our VLRT framework. So it really helps us not only on the ESG schemes, this learning will also help us in implementing ESG phenomena across all schemes. So it's I think it's an opportunity for India for next 10 years perspective.
Betting on an earnings recovery when it comes to sectors or even individual stocks in this quarter?
Kamab, can you repeat the question?
I was talking about where you see opportunity based on an earnings recovery within sectors in this quarter.
So whatever result we have seen so far, though it's just a beginning, Clearly, like Tata Sponge came out with excellent numbers. Some of the two cement companies, whether it's AC or Ultratech, which has reported a very good number. So we can clearly see the thesis which we are talking about, that we are in very early stages of recovery, and with the COVID cycle also at least looks like peaked out in India. So I think the domestic company, a good domestic consumption company, particularly infrastructure linked company, I believe the early signs of data is already there. So we like to concentrate on these space.
Okay, and you continuing to avoid NBFCs? What's the outlook when it comes to the liquidity within this space?
So as we rightly said in the previous interview, I talked about right from March till July, the easy phase of liquidity has peaked out. Okay, so we remain in the elevated levels of liquidity globally, but the momentum has started declining. With that background, I still believe that some of the developed market has potential to underperform from the current levels. And within that background, the leverage economy stock, which talks about banking and NBFC, still has potential to underperform the sector which we are looking at. So we are not very bearish right now, as we were bearish in the beginning of the year for the financials. But I will look at very selective stock in the both banking and financial space rather than looking at the sector as a whole.
Sandeep, just to take the point forward that you were making about economic recovery actually picking up and the fact that you do like cement as a space, something very interesting is happening in the entire home improvement ancillary universe. We saw a blowout set of numbers coming in from Kajaria Ceramics. Century Ply has been seeing quite a bit of traction build in fact, a couple of block deals as well on that stock yesterday. Anything of interest within this pocket to you?
So it's a really impact, which is like when we talk about recovery in cement, so by default the impact on these companies is consumption linked stocks on the building material. If I have to talk about, definitely results are good, but I think the impact will be visible, and I think it can only gather momentum going forward, because if this is the result, whatever we have seen, whether we talked about Kajaria or cement company at the beginning of unlocking phase, okay, when it's completely unlocked and momentum really picks up, because labor has still not returned completely. When you see the labor is completely started getting deployed, I think impact will be far bigger in Q2, in Q3 and Q4 for us.
Sandeep, great to have you on the show today. Thank you so much for taking the time out and sharing with us insights on stocks and sectors that you like and dislike and what's of interest right now.